This entrepreneur had been accidentally evading tax on $70 million for 4 years, even though he thought that he had done everything by the book. So in this video, I'm going to show you the 4 mistakes that put him just one audit away from a 7-figure penalty and how to fix them so that you can check to see if you are at risk too. My team does this every single week, and if you'd like us to review your setup for free, there's a link in the description. Let me start with the worst of his 4 mistakes. This entrepreneur is called George, and he had a rental property in Miami. He also had a yacht down there that he would charter out occasionally. All of this sat inside his Canadian holding companies, and his accountant never mentioned a problem. So George is Canadian, but these rules exist in almost every developed country. The UK has the same central management test. The EU mandated CFC rules across all member states in 2019. So the mistakes I'm about to show you are universal. But here's what George did not know. When you're a Canadian and you hold foreign assets that generate passive income, rental income, investment income, capital gains inside a Canadian controlled corporation, something called FAPI kicks in, Foreign Accrual Property Income. Under Canadian tax law, specifically Section 95 of the Income Tax Act, so the Canadian Tax Authority treats all passive foreign income as immediately taxable in Canada. Not when you bring the money back, not when you sell the property, right now, every year. And if you haven't been reporting it, the CRA can go back years, reassess everything, add interest and add penalties. George had been running this setup for 4 years. His Miami rental income, his charter income, his investment gains, all of it was FAPI exposed. None of it had been properly reported. When we showed him the numbers, George looked at me and said, "So I have been paying millions in tax for no reason for 4 years." Not exactly. He'd actually been underreporting, which meant he wasn't just overpaying in taxes, he was also one audit away from a 7-figure penalty for non-compliance. But FAPI was just the beginning. The structure itself had a fundamental flaw. Remember those 2 Canadian holding companies that George's accountant set up? On paper, they looked impressive. 2 separate entities, $70 million in assets. Professional, structured, but here's what nobody told George. When all of your global assets sit inside domestic corporations that you personally control, where you make all the decisions, where you direct all the activity, where the mind and management of the business is you, sitting in Canada, the tax authorities don't see 2 holding companies. They see you. There's a legal principle called the Central Management and Control Test. The CRA's own website says it clearly. A company is resident in the country which its central management and control is exercised. So it doesn't matter that George had corporations, because George was the one making every decision, directing every move from Canada. Those corporations are therefore fully Canadian for tax purposes. Every global asset, fully taxable in Canada. No separation, no protection, no layers. And it gets worse. George had dreams of spending part of his year in Miami. Maybe 5 months, enjoy the weather, build some lifestyle flexibility. He thought that that would make him basically not Canadian anymore, but the CRA would laugh at him. With his current structure, George could spend 6 months in Miami and still be nailed as a Canadian tax resident. All global income taxable, foreign property reportable, and if he ever tried to actually move, exit tax on $70 million. That freedom he thought he was buying didn't actually exist. So we had FAPI exposure and a structure that offered 0 separation. But there was a third problem, one that George had already experienced before. When George first sat down with us, one of the first things he said to us was, "I'm never going through that again." He was talking about his divorce. George had already paid $8.5 million to his ex-wife. And I don't blame him for wanting to protect himself going forward. But here's the problem. His entire $70 million, every asset, every corporation, every investment, was held in his personal name or in corporations that were fully transparent, directly controlled by him, with 0 layers between George and his wealth. So in Canadian family law, when assets are personally owned, held in local corporations, or owned through domestic holding companies, they're all fully reachable. Divorces, separation, spousal claims, common law claims, property division. George's setup gave any future spouse a 180-degree visibility into everything that he owned. And in a divorce proceeding, those assets would be fully exposed, fully contestable and fully vulnerable. He had already lost $8.5 million at once. And with this structure, he was set up to do the whole thing over again. No privacy, no protection, no legacy control. 3 major problems. But there was one more before I show you how we fixed everything. And this one could have brought the whole thing crashing down. When we asked George for his corporate records, he sent us 2 binders. Inside those binders, almost nothing. No actual minutes, no corporate resolutions, no intercompany agreements, no asset transfer documentation, no cross-border filings, no substantive records, just a local accountant keeping the lights on. George's $70 million in wealth was protected by 2 empty binders. And here's why that matters. The CRA has something called GAR, G-A-A-R, the General Anti-Avoidance Rule. If a structure looks legal on paper, but has no economic substance, no real governance, no documented decisions, no legitimate business purpose, the CRA can ignore it and unwind it. And that's how they reclassify corporations as shams. And then they'll reassess everything. And once they do that, they can pierce the corporate veil, which means everything inside those protective corporations becomes personally exposed. George's personal liability, George's personal assets, George's personal problem. He'd been flying blind for 4 years. And if the tax authorities ever decided to audit him, which was only a matter of time, he had no defense. So that is what we found. 4 years of accidentally evading tax. 4 critical mistakes that give the tax authorities every right to investigate and charge him. So here's how we fixed it. We didn't just patch up the holes. We rebuilt everything from the ground up. The goal was simple. Give George control and protection of his wealth without the legal ownership that creates exposure or tax liabilities. That is the holy grail of asset protection, and it requires separating 3 things that most entrepreneurs accidentally combine: ownership, control, and benefit. First, we moved ownership out of George's personal name entirely. We set up a foundation in a jurisdiction with 0 capital gains tax on passive assets, no forced disposition rules, complete ownership separation, and full privacy protection. This foundation doesn't conduct business in itself, it simply holds. And because George no longer personally owns the wealth he benefits from it, it is protected from divorce claims, litigation, and personal liability. No transparent ownership, no exposure. No 21-year deemed disposition rule. That's Canada's ludicrous rule that forces trusts to pay capital gains every 21 years, whether you sell anything or not. If you're in the UK, it's the 10-year charge. Most countries have some version of this. So the foundation that we set up for George is not subject to any of them. Second, we established a governance layer in a jurisdiction known for its banking excellence, treaty strength, and independent corporate oversight. This is where the real decisions get made by an independent board with documented minutes with real substance. This passes the mind and management test. George is no longer the one directing everything from Canada. There's a legitimate governance structure with independent oversight making real decisions in a real jurisdiction. So the Canadian tax authorities can't claim that central management and control is in Canada, because it's not. Third, we set up an operational entity in a jurisdiction with strong banking, excellent credit access, and clean cross-border flows. This is where income gets generated, where business activity happens, and where the day-to-day business runs. But because the operational layer is owned by the governance layer, which is owned by the foundation, George has full operational control without personal ownership exposure. The result? Before, he had 2 Canadian holdcos, 100% personal ownership, foreign assets all taxable in Canada, transparent in divorce, FAPI exposed, no documentation, 0 protection. After, a multi-jurisdictional architecture with foundation ownership, independent governance, proper substance, asset segregation, and full compliance. That's the difference between a structure that looks good on paper and a structure that actually works. If you're watching this and thinking, this sounds like my setup, probably is. Most entrepreneurs I talk to have some version of George's problem. A domestic holding company, foreign assets in the wrong structure, no real governance, no documentation, sitting on a time bomb that they don't even know about. If your annual tax burden is above $300,000 and you want to know where your risks are, then my team offers a complimentary private structure review. No cost, no obligation. We will look at what you have, show you where the problems are, and tell you what it would take to fix them. Link in description. But if you already have a structure in place, a trust, a holding company, anything offshore, there are 4 signs that what you think is tax planning is actually tax evasion. And most people have no idea until the audit letter arrives. I made a video breaking down exactly what to look for. If George had seen this video 2 years ago, he would have spotted every one of these problems himself. Click the video on screen to watch that next. And remember, stay sovereign.